Picture this. You're scrolling through your social media feed, and suddenly a headline catches your eye. U.S. housing market shakes global economy. Your heart skips a beat as you realize just how interconnected our world truly is. Whether you're a first-time homebuyer in Texas or an investor in Tokyo, the American real estate market affects us all. Welcome to the Savvy Finance Corner YouTube channel. Wealth begins with knowledge. The U.S. housing market isn't just a domestic concern. It's a global powerhouse that influences economies worldwide. It's one of the largest and most influential markets on the planet. It affects not only American families, but also international investors, construction industries, and financial markets across continents. When the U.S. housing market sneezes, the rest of the world catches a cold. That's why understanding its intricacies is crucial. Whether you're planning to buy a home in Miami or invest in real estate from abroad. Despite recent economic turbulence, U.S. home prices remain stubbornly high compared to pre-pandemic levels. The inventory of available homes is still tight in many areas, keeping competition fierce among buyers. But the landscape is shifting. Millennials and Gen Z are entering the housing market en masse, while baby boomers are looking to downsize. Meanwhile, interest rates have been on a roller coaster ride, significantly impacting affordability and slowing down sales in some regions. Speaking of regions, the U.S. housing market is far from uniform. Sunbelt states like Texas, Florida, and Arizona continue to boom, attracting new residents with job opportunities and relatively affordable housing. On the flip side, once hot markets like San Francisco and Seattle are cooling off, thanks to sky-high costs and tech sector slowdowns. And do overlook the underdogs. Midwestern cities like Cleveland and Indianapolis are gaining traction as affordable alternatives to coastal metropolises. Now, let's talk about the elephant in the room. Mortgage rates. These numbers can make or break a home purchase. When rates rise, many potential buyers find themselves priced out of the market, leading to slower price growth. Conversely, when rates fall, it's like ringing the dinner bell for hungry home buyers, sparking fierce competition. The affordability crisis is real, folks. Even small fluctuations in interest rates can mean the difference between owning a home and continuing to rent for many first-time buyers. Speaking of renting, it's becoming the new normal for many Americans, especially in major cities. Rental prices have skyrocketed in urban hotspots like New York, Austin, and Miami. Institutional investors are swooping in, buying up properties and converting them to rentals. While renting offers flexibility, it raises concerns about long-term wealth building. After all, when you're paying your landlord's mortgage instead of your own, are you really getting ahead? But where there are challenges, there are also opportunities. For the savvy investor, the U.S. housing market is ripe with potential. Short-term strategies like fix-on-flip in growing cities or vacation rentals in tourist areas can yield quick returns. Long-term investors might consider buy-and-hold strategies in affordable markets with steady job growth. And with many office buildings sitting empty, commercial to residential conversions are becoming an intriguing play. For international investors, the stability of the U.S. market and potential dollar strength make it an attractive option. Of course, no investment is without risk. The specter of economic slowdown looms large, and a rise in unemployment could trigger a housing market correction. Government regulations, from zoning laws to rent control policies, can impact profitability. The ongoing affordability crisis threatens to lock out an entire generation of potential homeowners, which could dampen long-term demand. And let's not forget about Mother Nature, natural disasters, and climate. risks are increasingly factoring into real estate valuations. So, what does the crystal ball say for the next few years? Most analysts are betting on a soft landing rather than a dramatic crash. Prices may stabilize in overheated regions, but continue moderate growth in more affordable areas. If mortgage rates decline, we could see a quick rebound in demand, reigniting competition. The rental market is expected to keep growing, albeit at a slower pace than the frenzy we saw from 2021 to 2023. Now let's get practical. If you're a buyer, focus on affordability and long-term value rather than trying to time the market perfectly. Sellers, be realistic with your pricing. Overpriced homes are lingering on the market longer these days. Investors, consider diversifying geographically and don't underestimate the power of rental income. And no matter what your real estate goals are, work with local professionals who understand the nuances of your specific market. To wrap things up, the U.S. housing market in 2025 is shaping up to be a complex and dynamic landscape. We're seeing a mix of stabilization in some areas and continued growth in others. The affordability crisis remains a significant challenge, but it's also creating opportunities for innovative solutions and investments. Remember, real estate is inherently local. What's happening in New York might be completely different from trends in Nashville or Napa Valley. The key takeaways: stay informed, think long-term, and don't be afraid to explore emerging markets and strategies. Whether you're a first-time home buyer, a seasoned investor, or simply curious about the economic impacts of housing trends, understanding these dynamics is crucial. We'd love to hear from you. Have you experienced any of these trends in your local housing market? You have questions about navigating the current real estate landscape? Drop your thoughts and queries in the comments below. And don't forget to like, share, and subscribe for more in-depth economic and housing insights. Remember, at Savvy Finance Corner, we believe that wealth begins with knowledge, and we're here to help you build both. Until next time, keep investing in your financial education.